Good afternoon, ladies and gentlemen, and thank you for staying and listening to our presentation. Standard disclaimer. When you look back and think of the last 18 to 24 months, there's certainly been a number of challenges for investors in the gold environment, and I wanted to compare us to some of those challenges. Obviously, one has been companies have been marked down for not being able to meet their guidance. We pleasingly have met guidance in the last 6 years, and at the midway point we said we're on track to meet for the 7th consecutive year. A lot of our peers have declining reserves. We've continued to offset depletion and grow reserves, and I'll show you the data behind that in the presentation. Also declining production. We're one of the few peers on the TSX with growth inbuilt into our portfolio. Between now and 2021, we'll see a 40% increase in our gold equivalent production. We also have seen what happens when you have single asset risk. We have 3 mines in our portfolio, minimum mine life 7 years, all with good exploration upside. Country risk has become a focus for people, particularly in the last couple of years. Pleasingly, our 2 biggest assets are in Nevada and Saskatchewan, which are normally ranked in the top 3 jurisdictions for mining investment. Poor corporate governance. We're on the 1-year anniversary from Marcelo Kim's speech here, which focused on areas of corporate governance, and I'll come back and look at that in the presentation, and also look at our track record of growing NAV, and in both cases I'll actually put some data up to support our position there. Obviously, some of the challenges for people is also liquidity. We're very liquid. We're trading over 1% a day. We're dual listed both on the TSX and the NASDAQ with very strong liquidity. And investors don't have to worry that they're going to wake up and see a press release that we've done a bought deal. The last time we issued equity to raise capital was back in 2010, and we have a best-in-class balance sheet with over $490 million US in cash. All the numbers we quote are US dollars. Looking at the guidance, so in each of the last 6 years we've either met or exceeded guidance both in terms of production and cash costs. And as we've said, we're on track to do that again for the 7th year this year. To understand the growth, this graph shows it well. This is gold equivalent production. The base is our silver mine in Argentina. Up until 2016, that was 100% our production. We're now treating stockpiles in 17 and 18, and going forward, that's our 75% share of the Puna operation, and I'll talk to each of these. The middle bar is Marigold. We bought that in 2014. That's in Nevada, a large low-grade open pit. And the top bar is the CB operation, which we acquired through the acquisition of Claude Resources in 2016. In addition to the 40% increase in production, you can see declining cash costs, so an increasing margin over a greater production base. And these, keep in mind, these are the base case for each of the operations. A lot of companies quote lower all-in sustaining costs than us, but seem to have trouble getting cash from the quarterly telephone call into the bank account. We've continually added cash to the bank account since the acquisition of Marigold back in 2014. Finishing Q2 at $494. That will come off this quarter as we pay most of the bills on the Chinchillas build, but then we expect it to continue to ramp up next year as we continue free cash flow from all 3 operations. I mentioned data behind some of the comments we made. This is NAV per share. It's independent. It comes from Capital IQ. It's the consensus of broker forecasts of our NAV, and this has really been driven by our M&A strategy, and then putting emphasis, continuous improvement on those assets. We've done 4 transactions in 4 years. We bought Marigold for cash. We bought the adjoining property Valmy for cash. We earned into Chinchillas mainly through spending money in the ground, and we acquired Claude through an on-market acquisition. That shows a success at doing what we're doing. Investors also want to understand we have discipline. Since we've done Claude, we've looked at 9 opportunities under confidentiality agreement and proceeded with none of them. That's not because they weren't good projects. Just from our point of view, we couldn't see value for our shareholders once you put some sort of transaction premium in place. You can see our track record there compared to the average of the peer group listed at the bottom of the graph. Talking about corporate governance, we take it very seriously. I'm the only executive director on the board, everyone else non-exec independent, particularly important, a non-exec independent chairman. We have 9 board members at the moment. That's a little higher than what we normally do, because we have 2 directors retiring in the not too distant future, and we wanted to ensure continuity and have some overlap. The graph on the bottom shows data. It was collated by BMO. First of all, sorry, go to that banner at the bottom on the left. ISS is our main proxy advisor. They allow you to put that banner on your publications if you score a 1. They do a scale of 1 to 10. 1 is best, 10's not the best. So we score 1. We're one of the few in the mining space that do. They look at a number of components, but one of them is compensation. And that graph at the bottom is a histogram showing how the peer group listed at the bottom, I think it's in alphabetical order to protect the innocent and the guilty, but you can see we are the only one that scores a 1 on compensation. All our long-term incentive is totally tied to performance of the company, either in terms of options, which are share price dependent, or performance share units, and we have critical ownership targets for all senior management. Guidance for this year for each of the operations: 325,000 gold equivalent ounces, cash costs in that low $700 range, and I'll talk to each asset and you can see what's happening at each mine. Marigold, our largest mine, it's quite an amazing mine. This is a run-of-mine dump leach. So we drill, blast, put in a truck. The only decision we have to make is, do we put on a leach pad or a waste dump? We don't crush, grind, float. And we still get 70% recovery with a dump leach. That's one of the 4 new 300-tonne trucks we acquired this year, which is helping drive production forward. This graph gives you a good overview of the momentum of the operation. We acquired it in 2014. So the 3 years before we acquired Marigold, it was running at about 150,000 ounces per annum. You can see in the 4 years since we've owned it, we're running at about 200,000 ounces per annum. That's driven primarily by operating the equipment harder. Goldcorp had just invested $160 million in a new shovel and new trucks and associated facilities the year before we acquired it. That was one of the reasons we find that acquisition so attractive. We paid $268 million cash for the operation. They just invested $160, so we paid about $110 for the ore body and the existing equipment. Looking forward, you can see that period of growth, and that's driven more by grade. The average grade of this deposit is only 0.46 grams a tonne, but we've been mining last year 0.37, this year 0.35, making profit, making cash. If you continue to mine below average grade, eventually you have to get to average and above average. And in 21-22 there, we're mining about 0.52 grams a tonne. Reserves here at the moment, 3.2 million ounces of gold in reserves, 5.7 in measured and indicated resources. So there's about 2.7 million ounces currently in M&I, not in reserves. And I'll talk to what we're doing to see if we can move some of that across next year. As you can see there, average grade 0.46 grams. This is an aerial shot of Marigold. To get an idea of the scale, from the bottom to top, about 5 kilometres. When you combine what has already been mined with what's still in the ground, this is a 12 million ounce camp, so one of the major camps within Nevada. If you, I don't even know if I have a light on this. I won't bother. At the bottom right, you can see what's called the basalt antler pit, and to the bit above that, the Valmy pit. We bought that property off Newmont after we acquired Marigold. Our basalt antler pit had to stop because it was a hard boundary. It was their ground. So we know we're going to continue mining across there. We'll come back next year and continue drilling in that area, and we're comfortable we'll be able to offset depletion next year. This year we're more focused on that area called Red Dot in the upper centre on the left, and the next you'll see a cross-section through that area. The way to read that cross-section, the top yellow line is the current ground surface. The light blue line is the reserve shell done at $1,250 gold. The resource shell is done at $1,400 gold. It's a bit hard to see there on the hard copies. You'll see that that large area between reserve and resource is called Red Dot. There's over 1 million ounces there. It tends to have more red cells on it, which means it's higher grade, but also more white above it, which means a higher strip ratio. There are 3 ways to convert that into reserves. 1, just cheat and say the gold price is going to be $1,400. We're not doing that. 2, look to increase the amount of gold and decrease the amount of waste. So we're infill drilling there. We've increased the budget by 80% this year. We're spending about $9 million, most of it in that red dot area. Most of it's already in M&I, some's in inferred. What we've found at this site historically is the more you drill, the closer the spacing, the geologists get more confidence about extrapolating the high-grade structures. So our hope is that we'll see an increase in the contained gold and also a decrease in the strip ratio. The other way to convert it is also lowering your mining costs, and that's part of a study that we've called an expansion study or equipment replacement study. Scenario A there is the technical report we issued a few months ago, and this is the base case for this mine, 10-year mine life. We've got a large rope shovel, 2 hydraulics, feeding a fleet now of 25 300-tonne trucks, mining at about $1.50, so good mining costs. And at the moment, that's the base case. The 2 hydraulics need to be replaced, so in the technical report, we've assumed replace like for like and continue doing what we're doing. If we do that, that million ounces in red dot is still a call option on $1,400 gold, so still value there. Before we make that decision, we said we'll look to see whether we can expand the fleet to lower the mining costs. So scenario B is the other extreme. We're looking at a new rope shovel. If you bring in another rope shovel to replace the hydraulics, another 10 or 12 trucks, we're not sure of the exact number, that'll help push the mining costs down. Our hope is that a combination of pushing the cost down and increasing the amount of gold will justify that expansion. It would be over $100 million when you add up all the gear. We will only do that if there's a double-digit IRR and that we're comfortable with. We won't do it just for the sake of growth. There's a scenario C, which is actually a permutation of that, saying it doesn't justify the capital hurdle to invest, but is still cash flow positive by adding it to the end of the mine life. So at the moment, the base case assumes mining stops in 2028. We continue flushing the leach pads till 2032, and then we stop. Scenario C would be take the equipment in 2028, do 2 years of pre-strip on red dot, then get back into ore. So you see a production dip in 29 and 30, and then production increase and hopefully another 5 years of mine life. That optionality, the potential to add 30% to your reserve, I think would be impressive at any mine. But keep in mind, next year Marigold celebrates its 30th year of continuous operation. So that amount of embedded optionality is quite amazing. Moving north, totally different environment, different mine. This is CB, high grade, narrow vein, underground, and we're waterlocked here. We can only get in bulk supplies during the winter road, ice road during winter. Starting with the reserve base, the average grade of the reserve just under 10 grams a tonne and over 1 million ounces of MI and I. This graph shows the forecast production from the PEA, the Preliminary Economic Assessment, which includes inferred. A couple of numbers worth noting in here is the year before we bought it, the mill was running at about 870 tonnes per day. This year's budget assumes 1,000 tonnes a day. Thereafter, we assume 1,050 tonnes per day. The difference between the last 3 years, because it's constant throughput, is purely grade driven as we get into the deeper, high grade material. We believe that has a degree of conservatism built in now because of this. This is actually a plot of our daily throughput at the plant. We acquired it in early 16. Our peak, you can see a fairly linear increase in throughput. Our peak daily production now is 1,419 tonnes. And that increase in production has predominantly been done with very limited capital, just by operating the plant harder and faster. If you're into process control, you don't like the look of that graph because there are a lot of dots below the line. You want to try and reduce the number of minimum days. That's driven because we've moved the bottleneck from the mill back to the mine. If we're in Nevada, we'd buy 2 trucks and 2 loaders and drive them down to the mine. But because we're at the end of that ice road, we can only bring the new equipment in next year. So I would hope from end of Q2 next year, you'll see a lot fewer dots below the peaks, and so lift the average up. And that's why we think that forecast I showed you before has a degree of conservatism built in it. This is all a grade story at CB. It's open at depth at Santoy. This is the actual Santoy mine. The old CB mine went down to a depth of 1.3 kilometres. We've got resources down to 750 metres, still open. This year we're focused more on conversion of green to yellow, inferred to M&I. Next year, in the second half in particular, we'll focus on seeing if we can increase the amount of inferred. We increased the budget here by 80% as well, $9 million being spent at the site, about $3 million on this page looking for more inferred and conversion, $6 million, 2/3 being spent looking for something new. Here, this is a plan of the operation. The yellow was the original ground held by Claude. After the acquisition, we entered an exploration joint venture on the Fisher property. The reason being is that red line down the middle, that's the Santoy Shear. We now have 30 kilometre strike length, most of it undrilled, or 2/3 of it undrilled. There have been 2 discoveries on this site of million-ounce deposits. The best place to find a new discovery of high grade is near an existing one on the same structure. It's worth understanding the history of Santoy because it shows the perseverance you need. It was discovered as a small quartz vein outcrop. Channel sample had some gold. They came back the next year to drill off the frozen lake. No, nothing. Second year, drilled it, nothing. Third year, drilled it, hit high grade. You need to persevere. So as much as I'd like to make a discovery here in the next quarter or two, we'll still be drilling here 4 or 5 years. There's tremendous prospectivity on this site. Finally, the third operation in Argentina, Puna. It's our Perquitas plant combined with Golden Arrow's Chinchillas operation. We own 75%, we're operator. This just shows the first 3 years of our 75% share. It's about 7 million ounces of silver, order of magnitude just under 100,000 ounces of gold equivalent. We put it there as silver equivalent, so you can see the middle bar there is lead, the top bar is zinc, so we'll start to get some base metal byproduct credits. We'll report that as silver net of byproduct credits. Progress is good. That's the pit. We're trucking ore from Chinchillas, 45 kilometres up to our plant. We've done a couple of batch trials. We've produced commercial concentrate, so we're happy with that. And we've said we're on track for commercial production by the end of the calendar year and comfortable with the budget. We'll obviously update the market when it goes into commercial production. The other bit of capital has gone into the dome over the crushed ore stockpile. Very windy environment. We have lead in the ore there, so just trying to maintain that, and also new tailing system. Finally, just one more thing to touch on. The portfolio from the old silver standard, we had a lot of assets in there. Anything in light blue we've sold, but we've tried to maintain ownership. The important one is Pitarrilla, one of the largest undeveloped silver projects in the world, 500 million ounces in contained silver. We did a feasibility back in 2012. Totally different price environment. Luckily, we didn't build the configuration that was proposed then because with the drop in the silver price, it wouldn't have been economic. We've done a desktop study to look at something focused on the high-grade, smaller capital. It looks positive in this price environment, so we've handed it off to the external engineers, and we'll make a decision by the end of the year whether we move forward into final feasibility. Importantly, the underground's already permitted and we have water, which are normally the challenges, and it's in Durango, which is one of the better states from an operational point of view. So that's where we are. 3 operations, good portfolio, totally committed to increasing shareholder value, best-in-class balance sheet. We can fund internal growth opportunities, but we also look continuously for external growth opportunities, but with good discipline. 1 minute and 44 for questions.
Question up here in the front.
Michael?
Hey, Paul. Probably one of the only companies with a corporate governance slide in their deck. Where's that DNA coming from?
Where's the what?
Where's the DNA coming from? Where's that culture coming from?
A lot of things. I always say there are 2 DNA strands in the company. One's BHP, there are a lot of us from there, and one Placer. I also worked in a junior, and I think there are benefits from majors, benefits from juniors, and there are negatives from both. From the majors, it's a lot around governance, but process, continuous improvement, etc. Smaller companies tend to be more nimble. I think really it's driven from everywhere through the organisation. We have a very committed non-executive board, and that to me is the key. I wouldn't work for an executive chairman. You have a governance overlooking management, that's their job, and we're there to run the company.
Any other questions? No?
Maybe I'll just ask another quick one if I can,
Sure.
Greg. Just on M&A, you have lots of levers to pull given the balance sheet you have. Can you give us some color on if you were to do something, where it would be and what scale, development,
Sure.
producing?
And there's one question over there, I think. Anything from production through to early stage, probably in the Americas. We would go outside the Americas for something exceptional. We're agnostic to metal, gold or silver, but there are a higher probability of gold.
My question was the same, but I guess I'd add a little bit to it. In terms of size and scope of what you're looking at potentially to take advantage of opportunistically outside for growth, would it be something that you'd keep in a metric of 25 to 30% of your existing operation, or would you go for something bigger?
It's really about margin. So before we got Claude, people were saying we have to go for something bigger than Marigold. That doesn't make sense. It's all about margin. So if it's small but high margin, we'll take it. If it's big and lower margin, as long as it meets all the other hurdles, we'll look at that as well.
Okay, thank you, Paul.
Thank you.
That's great.